Hello everyone, welcome to our Egyptian online seminar group. First, keep it conserved, then if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming the Professor Alfred. Alfred. Alfred is a professor of accounting at the University of Graz and chairs the Institute of Accounting and Control and the Center for Accounting Research. His research interests including financial accounting and reporting, management accounting, sustainability reporting, and accounting standard setting and enforcement. Most of his research use analytical modeling such as a game theory, agency theory, and information economics. His research appeared in top-ranking journals in accounting, including the Journal of Accounting and Economics, Journal of Accounting Research, and the Accounting Review. And he served as president of the European Accounting Association, president of the German Academic Associations for Business Research, vice president of the American Accounting Associations, and the International Accounting for Accounting Education and Research. Now we will start our seminar with dear Professor Alfred Wagenhofer.
Thank you very much for the invitation to speak here and for your kind introduction. I try to share my screen. And hope that you will see this. First of all, I'd like to briefly comment on what this fancy title suggests and what I can deliver and what I can't deliver. So there's a lot of things happening in sustainability reporting in many countries today. And I'd like to give you a little bit of an institutional background of what happens currently in this area. I then try to talk about regulation. Why would disclosure regulation in the first place be the right instrument for pushing more sustainability? Then I'd like to go along with what are kind of differences between financial accounting and reporting and sustainability reporting. That is, what is similar, what is maybe very different. And I'd like to shed light on some of the key concepts of sustainability reporting. And we'll end with something that's a little bit of looking forward. So this is more like providing food for thought and possible interesting research topics. I call the challenges and opportunities for research, but it's more like more questions than answers I would have. So stay tuned with this. First of all, this talk is based on a paper I've written and was published early this year, Sustainability Reporting, a Financial Reporting Perspective in Accounting in Europe, but I'll amend it for this talk. So it's half a year or a year moved on and things happened in between, and some many things were kind of new. So it's you can read this one, but what I'm gonna talk about will be a little bit more than what's in the paper. So to get more to the basic issue, why would disclosure regulation in sustainability help implement sustainability goals? First of all, I'd like to briefly mention that sustainability reporting is not new in accounting research. So there have been various streams of academic literature, and starting in the 50s, probably even earlier. And then obviously in the 70s, it was a big jump. And the contributions at that time sometimes came from accounting academics, but also from many others outside accounting. And examples like what's coming from a little bit outside, but also from accounting is corporate social responsibility, CSR. That was sort of the key buzzword for this sustainability reporting earlier. there's several different developments and ideas, like the triple bottom line, so profit, planet, and people, would be something how to combine those and get sort of a fuller picture of what companies do. So, and then from the regulatory side, we've seen a lot of developments that will go for voluntary sustainability reporting standards. And here is a couple of examples. That's called the alphabet soup by many. So because you always try to find sort of 3 or 4 letters that give you some idea of well-known kind of things. So I won't go into details, but I sort of this is sort of a base where the whole issues with mandatory sustainability reporting would start. So the key thing, what we see nowadays across the world, I think, is regulatory developments and regarding mandatory sustainability reporting. This is an important shift. I mean, if you do something voluntarily, then obviously the company must think it has some benefit if it voluntarily adopts such standards and reports on sustainability issues. Mandatory is like very different because everybody has to do this. So what the European Union, for example, did, and since I'm sort of in Europe, so I look a little bit on that, but also sort of in a broader perspective. But European Union already started in 2014 with this non-financial reporting directive, which required large companies to issue sustainability reports, but it didn't really sort of give very detailed regulations on those. So it mentioned mainly topics that should be covered. Then there came this European taxonomy that would be a requirement for large firms to publish information about investments and operation expenses that would be invested in green activities. And so we had this green-brown shift here. 2 years later, Corporate Sustainability Reporting Directive, CSRD, came along, and we required a full-fledged sustainability reporting that firms have to do. And a year later, European Sustainability Reporting Standards, ESRS, which were developed by AFRAC. That's an association of sort of the different member states that usually got into international financial reporting first and was advising about adopting IFRS in Europe. But now then they got this mandate to develop these standards on sustainability reporting, and they published that last year. And one more development was the Corporate Sustainability Due Diligence Directive that came into force this year in the European Union. And it is like an interesting thing because it requires companies to really manage sort of risks, particularly human resources and things like that, which sort of duplicates what they had to report anyway with the ESRS. So we got sort of requirement to do something, and we got a requirement on the same thing to report on that. And this is like an interesting sort of way to almost over-regulate things to some extent. I'll come back to that one. In the US this year, we saw the SEC coming up with a thick rule about climate-related disclosures for investors. And there are many other countries currently with initiatives, regulatory side, some already have some standards in this regard, and others are about to adopt such standards. And what we also saw, particularly probably because European Union just jumped forward given the legislation and had to follow, that the IFRS Foundation started thinking of whether they should do something in terms of sustainability standards, and they built sort of another arm in the foundation, which is the International Sustainability Standards Board. That was in 2021. and it came up with two standards already last year, IFRS sustainability disclosure standards. The IFRS Foundation has this sort of second board to also try to go on with financial reporting, but also capture and use sort of sustainability disclosures, and it started to really combine others with it. So the SASB standards were consolidated with the IFRS Foundation, the CDSB, and also Value Reporting Foundation. So these standards already moved into the IFRS under the umbrella of the IFRS Foundation, and what we've seen, like 20 years or so, when we had this IFRS financial reporting standards adoption probably across the world, and many countries would see this as sort of benchmark, and many adopted it directly or indirectly. We are now in the same situation here with sustainability reporting. So currently there are these different initiatives. IFRS tries to bring them together and to try to be probably the international standard on sustainability reporting. But currently what we have is mandatory disclosures by different organizations. And so the question then is for sort of companies, particular sort of international multinational companies, which standard would we follow, and what does the future bring here? And so the standard setters talk to each other, seek interoperability or coherence or consistency or alignment, and many other terms have been used to say, oh, this is like quite some differences in standards, even though in many respects they would be aligned or similar, but there might be difference in uses, might be difference in coverage, in detail, and we'll come to that in a minute. And also the question of political influence is an important one for many countries. And what we've seen recently is like that the standard setters, different standard setters talk to each other and come up with sort of assessments of what's sort of similar, what's different, and the main conclusion they come up with is there's a high degree of alignment. In principle, aligned are these words that are used, which suggests that they have sort of similar views, similar ideas in many respects, many similar disclosures, but also different disclosures. And the difference is in this regards I talked about just before. So this is like a situation that's not ideal for multinational companies, but also not for international comparability of these disclosures, particularly if many of the sustainability issues are really sort of global issues. It's not that one country jumps, on the bandwagon and brings all things forward. So, one needs really sort of a global thing. So this will be an interesting area to see how these standard setters, different countries adopt maybe IFRSs in sustainability disclosure standards or not. But that's currently a big discussion. I'd like to go more into sort of the more fundamental question, and this will be why employ mandatory sustainability reporting after all. So there have been a variety of regulatory options, or countries and groups can do it very different instruments to do thoughts to come up with ESG objectives and how to get firms to take care of these issues. So one is used, which is prohibition of certain activities or inputs. You must not use particular inputs, but you can ban particular technologies. European Union tries to get rid of fuel motors and things like that, or ban of products. So this is more the really direct thing that works to some extent, but has also disadvantages. Another one is countries can come up with subsidies for, say, green investments. or penalties for brown investments or pollution or whatever. So this already occurs. Another more market-oriented approach will be pricing of externalities, because many of the sustainability concerns or issues are really externalities to the firms, and they don't see a price on those. It's priced to the community in overall. And so, for example, there are existent emission trading schemes, so particular carbon certificates, and this is a way to constrain the quantity of emissions, for example. So you get a ceiling of how much quantity of particular emissions there possible. Otherwise, you have to constrain your production. So that's the one aspect. The other aspect on these pricing opportunities is carbon tax, which also European Union has one, for example. Carbon tax prices the externalities and or emissions. So you pay sort of a tax when you emit CO2 equivalents, for example. And since this is a global thing, one needs to take care of border adjustments, what other countries do in this regard. And for example, the European Union has this carbon border adjustment as well, which is brand new, and we'll see how that works. So these are instruments. More on those, one could influence the access to financing of firms. And this is precisely what the European Union does with the taxonomy. So by reporting green or brown, banks have requirements to particularly invest in green technologies and support firms with that. We got ESG ratings for direct capital market transactions, where firms borrow money on the capital market, and they come with ratings, and they get cheaper money, for example, if they are greener in a sense. So financing would be this opportunity, or increasing due diligence requirements. And this is what I already mentioned with the CSDDD. So due diligence directive. So we got reporting, and we got requirements to take care of. So management needs to do something to avoid child labor and things like that. So now on top of that, we see transparency regulation coming on, and this is kind of the interesting thing. So the question then is, what does transparency regulation do in this regard? And many would think, oh, transparency is always a good thing, and it should work because you know much more about firms, and then you can make your decisions. But the way it works is relative to the other instruments that we've seen in terms of policies, is like there is an effect, but the effect is indirect in a sense. So we got a number of empirical studies that show that it works. So when you have to report on something that's considered or viewed as bad, then firms try to avoid this as much as they can, right? So the problem here is it's really difficult to assess effectiveness and efficiency, and I'll come back to that one a little bit later. Particularly, and this is what happens right now across the world, if many of those regulatory actions are taken at the same time. So we have an overlay of different changes, and so even if one could come up with a clean setting to see something, you always have other confounding effects in there, which is a bad thing in a sense to evaluate policies. Transparency is generally viewed as positive, and very few people would argue and say, "Oh, let's keep it, silent and don't be transparent." But there are costs to that as well. So particularly, it's costly to prepare. Preparation cost if you collect data and let them be audited, for example. And for sustainability reporting, and I'll come to that as well later on, we require a lot of value chain data. So the scope of affected firms is much larger than those that are really regulated in the first place. So if you're a supplier or customer firm, you get those information demands by the other firms in your value chain, and this makes it really sort of costly. And the other one is like there are limits to transparency, and one would be commercially sensitive information. And there are also unintended consequences to some extent. And I won't go into detail, but just maybe brief examples on unintended consequences. So one has been viewed like 15 years ago, the disclosure of fair value by banks. Fair value disclosures, when they fluctuate very strongly, may increase the threat of bank runs, and it could collapse the whole financial system. And 2008, it was like close to that one. So by reducing disclosures or viewing cost instead of fair value, for example, which dampens the effects, one can prevent that to some extent. And another example, I think is an interesting one. It doesn't come from accounting though, but in the US they had a patient safety disclosures by hospitals, so for cardiac surgery. So what happened there is patients can choose where to receive treatment. And so the state required you have to have a track record. How well did you treat patients, and were they healthy afterwards, or would they casualties and things like that? So the problem with that was that you got a selection bias. So if you see that there are good doctors in a hospital, then you get all they would go to get all those most difficult to treat patients, right? And even if they are the best doctors in the world, right? It will be they probably have higher fatalities than others. So this is selection bias we know from the empirical literature. Or the other thing is crowding out. Doctors do not want to treat high-risk patients because chances are higher that they are bad in the marks, right? So these are a couple of examples that come up with limits to transparency. But commercially sensitive information is something, and I'll come to that a little bit later, where sort of in sustainability reporting, where you have to, you're required to disclose targets and your actions towards these targets and policies and achievements of targets in the long run, as maybe even 10, 20 years, particularly with climate change. So this may create sort of really commercially sensitive information in that. This illustration here, the Johnson glass houses, I mean, this was like in the 60s or so. And the question here is, would you like to live in such a house, where it's full of glass? I mean, I need to add, this was situated in a park, and there was like 2 kilometers out a roundabout where you couldn't get close, right? So it wasn't that bad as it looked like. So the mechanism really is you force disclosure, and you want to see how people react, how other firms react to disclosure, given what they expect to see from what others do. So we have that in financial reporting as well. So that's called real effects literature, and there it's like an unintended effect. So the intended effects in financial reportings provide neutral information. So the AFRAC conceptual framework, for example, tells you a financial report should be useful for investors' decision making, unbiased, and all these sorts of things. But of course, even in financial reporting, some biases remain, and cost-based measurement instead of a value. All this conservatism kind of discussions and debates we have seen are like biasing information to some extent. But the unintended side effect is that the decision or the information in financial reporting is decision relevant to investors. So it changes and affects the market price. And once management is interested in short-term market prices, then it might bias real decisions. So accruals management, based management, earnings management, but also real earnings management. And this the real effects in this kind of literature in accounting. For example, overinvestment as a signal of favorable future situation. So invest more because then people interpret this, oh, the future must be bright. So I increase the price and I'm gonna pay for these firms, right? Or underinvestment if investment is not recognized by commingled with operating expenses because it reduces profit in this year, even though it's you think it's for future years, right? So these things happen, but they are not intended in this regard. We also see this in tax regulation. So usually the tax should sort of taxation of the actual income in a period, which should be very neutral essentially, but there are explicit tax incentives for specific activities or investments, right? So the tax a regulator comes in and offers tax benefits or costs to these things, which should in sort of provide real effects in this regard, and this is intended as well. In sustainability reporting, things are a little bit different. So of course, the original version is sustainability reporting is intended to influence decisions by firms. To move to a better society or environment, but it works extremely indirectly, and you see this on this graph on this slide. So the firm writes a report, and there are different stakeholders who read this report and then might take actions or react to this information. So the classic one is investors, and the question there is provision and cost of capital. This is also what we have in financial reporting. But very often these sustainability things are important for other groups of stakeholders, and one important group will be customers. And so if you like to buy green products, then you look for this information. If you see these products are greener than others, then you increase your demand, or you're paying a higher price for those if you like to push that. Same thing goes for suppliers, product services. So if I want to be green, I want to have a green supplier. Competitors, the question there is then competitive disadvantage that you might have because your competitors learn a lot of what your strategies are, and I briefly mentioned that already. And then there's this group of other stakeholders, and there could be many different effects, like NGOs pushing for one particular item, for example. So essentially, how this works is it creates the disclosure, creates awareness among users and possible reactions, and the instrument is pressure by stakeholders. Okay. The problem for firms is it's a high uncertainty how effective this is, because there's so many stakeholders and you don't really know. So the uncertainty is like a big issue in this regard. But this is how real effects in sustainability reporting work. Does it work? I already mentioned it briefly. There's a lot of empirical evidence already. Here's a couple of examples just taken from the literature. Mine safety, if you have death rates in mines, then by disclosing them, you push firms to take care more about the workers. Extraction payment disclosures, licensees, increased payments, NFRD already induced ESG activities, carbon accounting reduces emissions to some extent, or carbon footprint information on food affects consumer behavior. So the first four examples that I mentioned are empirical, in particular settings where you can sort of distinguish and measure what these differences. Whereas the last one is an experimental study that price tagged food differently and put this additional information and had people choose food. And would they pay more for it, or would they buy it more than others? So what we see is it works. There is this effect. However, it doesn't really help in explaining all of the issues. So it doesn't show how effective and efficient it is as a regulatory instrument. Okay, so we see it works in the intended direction, but could it be more or less, or is it really this disclosure enough? Would we require more disclosure, less disclosure, and things like that? All right. So I would like to come now to sort of comparing financial and sustainability reporting, and I'll try to do this. This is like the overview slide, what I'm gonna talk about a little bit more later on. So as I said, intention is providing neutral information in financial reporting, whereas sustainability reporting has actively the intention to influence behavior to a greater good. Financial reporting is investor and capital market oriented, whereas we see in sustainability reporting investor oriented would be IFRS disclosure standards or the US SEC rule, whereas there is other group who have stakeholder oriented, so much broader perspective. GRI and ESRS would be examples of this setting. Aggregation is a big issue in financial accounting because the end result is performance, and you want to have a profit, you want to have a return, and you need to measure those things so you get monetary results, and we have supporting textual disclosures. Whereas sustainability reporting is an immensely huge set of data points and textual disclosures that we see. Since we have aggregation in financial reporting, there is a need for recognition, measurement, classification rules. Whereas in sustainability reporting, we almost have nothing of this sort. So it's just unconnected input, outputs, status measures, and I will give you a few examples of that later. We have accrual accounting, financial accounting, no accruals in sustainability reporting, so it comes as it is here or there. So it's very hard to compare or easy to influence to some extent. The information is about the reporting entity, which is a control concept. Sustainability reporting tries to come close to this reporting entity concept, but it also includes value chain information, as I mentioned, and we'll talk about a little bit later. Financial reporting is primarily past information. So last year and how was performance, and then you compare over the years. Whereas sustainability reporting has a big idea of particular future information, even 5 or 10 years forward. And this is very different. We try to avoid this in financial accounting. And accounting for risks is there, but not for opportunities. These are not explicitly required. And policies and targets, whereas we see this in sustainability reporting, and also comment on this one later a little bit more. So
Alfred?
let's come
Alfred?
Yeah, okay, sure.
One question, or I don't know if it's a comment. You mentioned it on this slide, right? So this sustainability reporting is much more about inputs as well. So at least we have more precise information about inputs, right? And I think that's an important difference to financial reporting. You mentioned the real effects literature. We have unintended real effects mainly because we don't have information about inputs. We don't observe investments, right? And this seems to be a crucial difference with regard to sustainability reporting, where we try to tackle the inputs. And this seems to be, for me, this seems to be a less indirect way to control behavior or steer behavior in a certain direction. I know this is only one aspect of sustainability reporting, which is more broader, but I'm really unsure if this is more indirect, what's going on here.
Okay, I mean, one can of course argue that by aggregating, you lose information. I mean, and you measure it, and you know the measurement rules, but you can't get back to the original input outputs in quantities.
You lose control in some sense.
No, it's true. Yeah, I mean, I agree with that. But what we see that the many data points, it's like, you know, there's a reason why we have aggregation as well, because we need these performance measures, you know, to compare companies. If we compare only one company over time, I mean, then that's more helpful, I guess. To see input-output relations rather than pricing changes, so you can disentangle these things, right? This is what I think you mentioned, which makes a lot of sense actually. But comparing companies, you know, it's getting much harder with that. And but I'm gonna talk a little bit about aggregation later on, so we can also discuss it later on. Thank you. Okay, so the many data points, and this is exactly what Uri mentioned, is we got so many things that are interesting in the first place. So what I have here is ISS corporate data sort of comparison with IFRS S2 requirements. These are the climate-related disclosure standard and the TCFD recommendations. And so like a third of that is pretty much similar as the green part. Then enhancements like 30% or whatever, and then almost like 50%, sometimes even more in particular areas, new requirements. So it goes on much beyond voluntary disclosure. Usually I would have expected different, the other reverse thing. So voluntary is like you choose what to do, and you get sort of a sense to be better able to compare and readers to understand what you're doing. So you need this kind of framework, but mandatory requirements, overshooting voluntary requirements is kind of an interesting observation. Even worse in this regard would be the ESRS, and here's the table of the comparison or the data. What you see here is in the top table, like 800 disclosures in those ESRS so far, and 269 additional May disclosures, whatever that means in this regard, you know. And sort of the breakdown in the bottom table is the data points that are numerical, and this will be like 30% will be numerical data. The rest will be narrative, you know. But even 238 quantitative data, I mean, it's really hard to digest for many people. Okay, so this creates this tension where you say, oh, I pick only one of those, for example. So I call it data graveyard. Standard setters, and the reason I believe this happens is that standard setters face many demands from different groups of stakeholders. And it's hard to say no to one because everything is somehow possibly important, particularly for a particular group. So the standards become voluminous. And this creates this bulk of granular information, raw input and output data, production process data that we see here. So we see the high preparation cost. Most readers would be interested only in a couple of data points, but not the whole thing through. So it will be selective reading. This is helped through by XBRL tagging, IFRS, ESRS, and also IFRS disclosure standards and have a taxonomy in the background. And I'll come to that in a minute again. And so we essentially generates information overload, and I mean, package leaflets of drugs. So if you have a drug and you look at, oh, have you ever read this? So probably not, because so much information is there, and you just don't want to consume it. So XBRL tagging. We had the same thing in the 1990s, late 1990s, where XBRL was developed for the financial reports. And so XBRL, as you probably are aware of, uses the data points and say this is like what you see in this slide here with company A, profit of the year. So this is like a number with a lot of attributes. So which year, what currency, you know, all sorts of things. So you see this in this middle part, decimal points, you know, and things like that. And you don't even have to read the report, but you plug it into some Excel kind of sheet, and then the system picks out this data and you can compare companies with that. So this is like the easy way of doing things. And I recall there were many ideas what to possibly do with financial reports when it's tagged. And one was choosing your reporting period. So, there's this background of data, and you can choose and say, I want these 5 months, or a financial fiscal year starting in February to the end of January or whatever. So you can choose from, you plug it in, and then the system creates your numbers. Choose your recognition measurement rules. You're not happy with intangibles not being capitalized, so please capitalize my intangibles, and then how would things look like? Create your own real-time statements. What will be the statement as of now in a second? Or continuous reporting, continuous auditing. None of that really happened, essentially, which is kind of interesting to me. But what we have here at the moment is like a sort of data points that are clearly described with attributes, what they mean. And we get the same with XBRL sort of tagging for sustainability reporting, which makes it even easier to pick out these 3 kinds of data that you're interested in, and you don't read all the rest. Okay, so it's a very different behavior, and there's no, as I said, no aggregation, and we'll come to that. So you pick out data, and that creates a lot of uncertainty for companies. What happens with that data? So aggregation. It's probably the key element of financial reporting. So financial performance, or what's my equity, what's my profit in a particular year. And the aggregation happens by valuing transactions and events, actually. So recognition measurement rules, and we get earnings and all this. And financial reporting developed over hundreds of years already. And there are very detailed standards. And the detail and complexity comes from the transactions that can be very complex. So if you follow the IFRS financial reporting side, what they usually do is like to currently to find, there are the new ways of writing contracts, and we need to take care of that. Financial instruments, there's a discussion, what's equity, what's liability, because it's a categorization, a binary one. And so whenever you write contracts, you can sort of go to the boundaries of your definitions and things like that. So what we have in the financial reporting, though, we have this aggregation, and then we get this aggregated information in the notes. Okay, and that's also used, sort of notes disclosures for if recognition measurement is difficult. So particular intangibles, for example, where very few of those could be capitalized under IFRS. Okay, so we see a lot of these. So sustainability reporting is pure disclosure. Adding similar items will be one thing, but otherwise, if the items are different, you count them differently. Okay. The only exception I think is important here is climate-related disclosures are measured technically in CO2 equivalents. Okay, so we get sort of over several emissions, sort of a common measure. And why is that? Obviously, because there are very different areas covered: environmental, social, governance issues, and we have very different views on what's acceptable, desirable, and what laws across the world would require in particular areas. And we have no conceptual framework so far for sustainability reporting. I mean, there's some discussion currently going on. Do we need a conceptual framework? And my thinking would be it's hard to see what the framework would look like, but what it should try to do is like to see what's really important and what is less important. The importance would differ heavily who you ask what is important. So residents in the area where you're blowing out emissions would behave differently from people in other places. And so it's not totally clear what a framework looks like, and I haven't seen really one. I mean, some call it framework, but it's not really sort of framework what we know from financial reporting. We get no accruals in sustainability reporting. So obviously, because it's this measure of inputs and outputs of various things, so which prohibits comparison of ESG performance across years to some extent, because we don't have stocks and flows. We also don't get sort of a catch-up of period amounts with the total. So if you have sum of profits is like sum of cash flows at some point in time, this brings you back. So if you make an error in one period, you get the counter effect in another period. But so it equals out. We don't see this in sustainability reporting. There is a potential for earnings management, call it earnings management, even if it's sustainability. So delaying investment. By delaying investment, you reduce inputs and you have a lower CO2. Investing in a project that's recognized as an asset rather than expensed. In intangibles, investing when emissions are low in a particular period, you know, or when they are already high, then you don't care about anymore. And next period will be the one where you can say, oh, it's a big increase and improvement in the next year. You can change, for example, CO2 emissions very easily by just selling your products in early January rather than end of December. So then you get lower emissions, or obviously supply chain management, make or buy decisions that you do that would make a difference, for example. So we got all sorts of things. And one example here is like if you invest in a climate-friendly technology that may increase emissions like cement once, but save emissions in the future. But you don't want to have this increase this year, right? So you don't invest, even though it will be good for the climate over time, right? I mean, the greenhouse gas protocol, and I'll come to that later, is more disclosures. In particular, they have the scope-free emissions from capital goods. That will be a particular sort of sub-item that will be disclosed, but still most people go only to the aggregate scope-free emissions, for example. But I'll come to that later. But this is like a trade-off that firms have, and this is like what we know in real earnings management in financial reporting. However, there's a demand for aggregation, and what most people tend to think of is when they look at ESG reports is how well is a company in ESG, and you can't find this. Okay, so there's so many data points and you have changes over time, but you can't sort of come up with sort of a clean measure of how well is it doing in particular areas. So that would require trade-off between different sustainability objectives. Should I invest more in social or more in environmental investments, things like that, or how much profit should I lose to improve sustainability objectives? That are the core issues, and the reporting doesn't touch on those. So since the aggregation is important, who aggregates? So we have the regulators to some extent, as I mentioned already earlier. The taxonomy tries to do this in a very weird setting or situation. They have a couple of areas and have like percentages of green versus brown investments, for example. Rating agencies do this, and the fancy thing I saw this one paper that's cited here, that if you get more ESG information, and you have several rating agencies that rate this company, and this company provides more information, then the can reduce the agreement of ratings, so the ratings get more dispersed, which is kind of interesting because, and the reason obviously is that if you have more information, you pick out that in your rating, but not in the others, so the divergence would be greater. And also firms need to aggregate internally for management decisions, and I'll come to that a little bit later when I'd like to talk about management compensation issues related to ESG. Reporting entity and value chain, I mentioned that a couple of times already. Sustainability reports are for the reporting entity, and this is like the IFRS 10 control concept in the bottom. So it doesn't include joint ventures associates. The Greenhouse Gas Protocol, for example, has an option to include those. But the key thing and key important thing here, in my view, is that many data relate to firms that enter this value chain. So you have upstream firms, you have downstream firms and end users, and particularly what we see with social issues or emissions, for example, you need to report about the upstream and the downstream firms as well. Okay, and even if this is like small companies, so questionnaires will be sent out to those companies to collect those data from them, and or otherwise, if you don't get the data, you have to estimate or even delist sort of the suppliers, for example, what's happening to some extent. Okay, so we got a lot of these things, which is kind of interesting conceptually, because that doesn't happen in financial reporting. So that comes from the Greenhouse Gas Protocol, which is a voluntary standard. And the key characteristics here are the distinguishes three scopes of emissions. The direct emissions, scope 1, scope 2, electricity, indirect emissions, and scope 3, other indirect emissions. And they are actually optional under the Greenhouse Gas Protocol, but you will see that's not the case in required disclosures in ESRS, for example. So ESRS E1, which is on climate, requires all three scopes after a phase-in option. IFRS S2 also requires all three scopes, whereas the SEC in the US requires only scope 1 and 2, and had a lot of intense discussions on the issues. TCFD encourages now scope 3 disclosures, but wouldn't require it either, because it's a fancy like concept and very, very weird from an accounting perspective, I guess. So what it does, and just briefly, so most of you probably know this anyway, is the reporting entity with the scope 3 reporting in the middle, the green arrow, is like what the company facilities and activities emit in terms of these different greenhouse gases that you see on top. The upstream scope 2 is like the electricity, and it's not clear why this is different from scope 3. So my understanding is that the reason is it's easy to measure, because the companies who supply electricity know where it's coming from, so they can give you the data. But all the rest is here upstream from purchased goods and other services. And here you need the value chain data. And the second part, the downstream activities, is what happens afterwards with the products that you sort of produce and sell. And the problem between scope 2 and 3 is, as I said, easy to measure versus difficult to measure. Particularly scope 3 downstream is extremely difficult to measure. So, and it's also very different to audit, very difficult to audit. What people use is general databases to some extent, so an average use of things. And if you want to do incentives for improving on downstream activities by using average data, this doesn't really help you, right? Because then you see what all the others are doing, and you can't distinguish yourself from the others if you don't use the actual data that you might collect to some extent, but otherwise you can't. So this is sort of the concept. And just to give an example of a real world company, SAP integrated report, you see the scope 1 and 2 counts for only 2% of the whole carbon emissions. Okay, 17% comes from the upstream and 81% comes from downstream. Okay, so so this is what you can really organize yourself and decide on yourself, it's very much harder to have an influence on those things, and it's very hard, probably in many cases, for having these 80% here, what the end users would do with your products of software. So the accounting issues with this is we have multiple double counting. Only scope 1 is clean. Everything else gets double counted, and you see it on this sort of graph in here. So you have all the scope 1 is for one company, and all the other companies have the scope 3. Then some have, if you power generation, you have scope 2 in here, and for those, you get all sorts of double counting. The scope 3 emissions have mostly occurred in the past. They are already out there. Scope 3 downstream emissions are mostly occur in the future and can only be estimated over the next 20 years. I mean, if you look at car companies, for example, they also have like 80 or 90% of their emissions as downstream by using the car, by end consumers. And this goes like 20 years in the future, but you report it now. If I sell the car now, all the expected 20 years disclosure will be presented in this statement in this year. So no accruals. As I said, reporting entity emissions correlate with volume of operations. So if I want to keep emissions low, I just lower the volume of operations this year or sales. And scope 1 emissions are production-based, whereas the emissions are typically sales-based. So you have differences in here as well, which is kind of interesting. And my explanation why greenhouse gas protocol does this is like it's mostly aimed at making policies, management politics and more policies. So you want to look at your whole value chain where you're in and see what's happening when you try to do strategic planning. But it's not necessarily a good tool for financial reporting and for audited sustainability reporting, in this regard. So we'll see how that works. So there's some criticism on scope 3 issues already in the literature. So Kaplan or Mann, for example, call it the fatal flaw. And there are some alternatives underway to show more like an accounting or management accounting perspective of how to do this. So reporting of greenhouse gas emissions that are realized, they can be audited, which means only upstream emissions could go in there instead of cradle to grave until including the downstream stuff. Aggregation of a value chain eventually shows how this flow works overall. And there's even examples of literature where they come up with accounting processes for greenhouse gas emissions, but again, only from upstream. So it's nothing in downstream because it hasn't happened. And it's not clear whether it ever happens. Okay, so it's kind of interesting to see how these things would maybe affect future standard setting in this regard, because people work very hard on convincing standard setters that this is like the better choice of doing things, particularly for audited sustainability reporting. Next thing I'd like to briefly sort of comment on is this extended reporting management process. So the management process, you see it in the top right graph taken from the TCFD disclosure. So you've got the governance, sort of management and supervisory boards and whatever. Then you develop a strategy. You have to consider risk management, and then you look at metrics and targets. Into how to provide targets but also to measure achievement of targets. And in the bottom of this one is the sort of contents from the IFRS disclosure standards. It has the same thing, right? Governance, strategy, risk management, metrics and targets being included in here in the standard S2 in this case. Okay, so this flows through, and this is something we don't see in financial reporting. I mean, if you like, it's a voluntary kind of thing, but it's not something that is mandatory. And So it's the management process that's being required for disclosure, and the greenhouse gas emissions, for example, can also be found in other topics where we see this. So you need an internal strategy development, for example, in greenhouse gas risks and reduction opportunities. You must decide on strategies, set targets, and also track performance. Okay, and see how this works. And we haven't seen so much so far. I mean, only from those voluntary adopters of financial of sustainability reporting standards. So the interesting thing here is, for example, if you look at ESRS, they have this E2 standard or E1, sorry, E1 standard. This does not require to have a policy and targets. But if you don't have it, you couldn't report it. So yeah, but you have to report the reasons why you don't have that. And this would be something where you say as a company, oh, then let me rather put in a policy and this information rather than saying, oh, we don't have one, because many people would like to be not like that, for example. So it puts pressure on developing some policy. For example, this could look like this, and I've taken this from ESRS E1 standard. So you're in, for example, in the base year in 2025, and these are current emissions that you have, and then you expect sort of growth in activities by growing as a company. You usually increase emissions, right? So, but still, you would like to grow in many regards. And then the question is, how can I sort of reduce those? And here are a couple of examples in the own operations, and then in value chain. And that will be your target year in 2030, for example. And this is like the Paris Agreement, kind of 1.5% aligned thing, and which is where you see, this is where you have to come down. So it's not only the target, but also how can I achieve the target? This is something that is probably highly sensible information. And then there will be the 2015 net zero target, for example, where you can't remove all the emissions. So you have to come up with some other measures to do something in this regard. So to compensate for that. So these are the expected disclosures, and then you would assess this for year after year. And this is kind of interesting from a financial reporting perspective, because as I said before, we don't have that here. And but investors always like to have that to some extent. So they usually come about and say, oh, let us give more information about the future, your plans, your targets, and whether you achieved your targets. And here's a case. In March this year, there was an exposure draft on business combinations, disclosures, goodwill, and impairment. And there was a discussion that the ISB wanted to introduce disclosures related to targets for key acquisitions and tracking the performance. So you say, oh, we purchased this company in this year, and these were the reasons why we would purchase it, and what we would expect in the future, and in 5 years it will grow, or whatever you have in mind by doing this acquisition, and tracking the performance. And it faced fierce resistance by companies, really big resistance. And so the ISB backed up and significantly reduced the disclosures in this exposure draft. And what you see here, you only disclose at the acquisition date the expected synergies and the strategic rationale. Investors always want to have that information. And then only for strategic acquisitions, which are the very big ones, key objective and targets, but not really sort of actuals. You have the actual performance, but it's very hard to you get exemptions on those things. And so they back down with only sort of the acquisitions, whereas in sustainability reporting you have that for many investments that you would have to track performance over time. So it's kind of really a new thing, and so I'm looking forward to see how companies do with that. All right. Information for management decisions. That would be another issue where we want to have aggregation for management purposes, particularly if you develop strategies for firms, but also as a basis for investment operative decisions. You need to consider all the effects of investments on not only financially, but also on E&S sort of issues, for example. So what the standards require is to describe management remuneration disclosures. I mean, there's a lot of management remuneration disclosure already out there, but these standards require those particularly with regard to the items or field that they cover. And these are most important for climate-related issues, and this will be sort of ESR S2 is for all ESG disclosures. IFRS S2 is for climate-related disclosures. So they would require description of the characteristics of incentive schemes, proportion of variable remuneration linked to sustainability matters, matrix and targets, percentage of executive management remuneration linked to climate-related disclosures. All these things will be required. I mean, as I said, many companies must disclose remuneration items very in much detail, but not necessarily to all these items that are covered by sustainability reporting standards. So the question then would be, how should the weights be set for financial sustainability KPIs? And this is an interesting research question. And I have here an example from Heidelberg Materials, a cement company. And this is what you see in many other company reports as well. So very sort of detailed remuneration schemes. And here, what you see here is ESG targets, 25% on the bottom right. Here, health and safety, free cash. There will be free cash flow, sustainable revenue, individual targets, but it's 25%. And then we have EBIT, ROIC, and total shareholder return. And all those have 25%, so they're equally weighted. And this is kind of fascinating from a research perspective, because it's not clear why that should or would be the case. But this is what you see. And the typical view, how these reports are probably read by most users, is that these weights should reflect the relative importance of these goals to the firm. So we have 3 short-term and one long, 2 short-term, 1 long-term sort of financial KPI, and then ESG as the 4th with equal weight. And what I believe many users would use and say, oh, this ESG targets percentage should be high, and should be at least as high as EBIT or whatever what we have here, and because it shows how committed management is towards sustainability goals. Okay, so it gives you sort of an indication of what you believe that the management would seek as the weight of that. Unfortunately, that doesn't work. So I used to do some stuff in agency theory as well. So agency settings with 1 effort and multiple performance measures. The question is, how should they be weighted? And agency theory looks at that. And what's really important is that the information should be statistically related to the measured and unobservable effort that you try to motivate. So the likelihood ratio is like the key element in here. So how strong is related to what you actually want to know, and that will be the effort of management towards particular goals. And the key criterion for weighting different performance measures is the signal to noise ratio. So signal is like how well does the measure track effort, and how noisy is it in the noise part. So, for example, if emissions, so you want a climate mitigating effort, right? But it's very noisy, particularly scope 3, right? Then, given you look at from agency theory, you would say that the weight should be very low because it creates a lot of noise, and noise is something that you have to compensate management for. You don't want to put too much risk on management compensation. Okay, so it should be low, despite emission abatement would be highly desirable, right? So it doesn't really tell you the whole story of what's going on there. Another insight from agency stuff is like that additional measures must be incrementally informative and beneficial. So the user's performance measure is greater than the cost of the measure. If two measures are positively correlated, their weights may be lower, and one can even show under certain circumstances that a desirable measure can get a negative weight if the correlation is very high with another measure that is easier to measure, for example. So even if you like to move on with sustainability issues, you might even get a negative weight optimally, and this is something you can't sell to the audience. Okay, so or another example, a pollution measure may be optimally rewarded if other measures indirectly over-incentivize. So more pollution it would be a positive thing in terms of your measure, because otherwise pollution abatement will be over incentivized and will be too heavily reducing your financial returns. So this is under certain conditions, but I think you get the sense. So the weights need not be constant. They could vary depending on the underlying production function, the measurement. So easy to achieve targets, a part of targets, you need not incentivize very strongly. But if it gets stronger, you might have sort of an increasing schedule, which you might do with stock options, for example, what one sees with some companies. And there is possible reward for luck. If, for example, a firm in the value chain comes up with a new thing and this is very green, then you benefit out of it because it's reducing your scope 3 emissions, and you achieve your targets easier. Okay, so that would be like being one would need to be very cautious with interpreting weights you see in management compensation. So this is a very difficult thing. Okay, so let me come to the last point I wish to make observations on, and that's connectivity. So what I try to do is like compare financial reporting, sustainability reporting, and see how they match and what the differences are and what maybe effects that would generate. There is a big discussion on connectivity among standard setters at the moment. Looking at it from sort of a bird's perspective, sustainability statement, the green part here, it's a sort of special part of the management report. Okay, so it's not financial statements, not so financial statements, but it's sustainability issues. And what people like to have is connectivity or consistency, compatibility, cohesion, linkage, and all those things, right? And what one sees in the first moment, so this is just additional disclosures. The idea here is that sustainability report does not depend on financial reporting standards. So they can be prepared on local GAAP, IFRS, so you don't really care much. So it's just, but it references financial data to some extent. So what we see here is sustainability reports requires connectivity with financial statements through references, for examples, so reconciliation of data, assumptions, qualitative information, inconsistencies should be open and clearly explained why that happens, or to some extent requirements in sustainability reporting requires the disclosure of financial effects, risk and opportunities. I mean, we see the risks in financial reports, not the opportunities typically, then that particularly for climate change and on workforce. So that goes only in one direction in a sense, but there might be others. So what you see on the right-hand side, the AFRAC has a big paper on thoughts about connectivity. The IFRS accounting, as IASB, has an exposure draft out there on climate-related other uncertainties in financial statements. And the fancy thing is, if I'm not sure whether you have looked at it, but it only contains illustrative examples. It doesn't change the standards. So it just explains, in a sense, that the standards are all right. If you interpret them correctly, you would give some information in financial statements on climate-related issues. So there's no need to adjust financial reporting. So it goes only sort of in one direction. That would be the idea. So, however, what we see and what is an important issue currently for financial reporting as well, that sustainability reporting generates new risks. And this is actually coming back to the intended effect of the whole thing. So it's regulatory risk, reputation risk, consumer behavior, for example. So these are new risks coming out from sustainability reporting. And the effects could be that your measurement of assets will change. You might have impairment, particularly more or less goodwill, useful life changes. You might change the discount rate because there's more risk in your company, or your credit risk exposure, provisions for environmental damage, decommissioning, and so on and so forth. And also coping with uncertainties. That's not very well stated in many standards. So 10 years kind of uncertainties, it's very hard to come up with something in financial statements. So essentially what happens then is you need more disclosures of assumptions. And what I also find interesting on this exposure draft from the IFRS accounting area is that it sometimes appears to check against user expectations. So if you report you have strong sustainability risk or climate risk or whatever in regard, but maybe not in the next 10 years, but in the future. So people would look into financial statements and then check whether that there was something that that is mentioned there, right? And so if you come to the conclusion that there is no need for impairment of assets or changing useful lives, kind of these things, you know, they will come up with questions. Hey, why didn't you report on those? You say there's no effect, but you need not report on no effect. And the exposure draft with the illustrative examples tries to say there will be some requirement for disclosing there is no effect, because people would expect there will be some effect. Okay, so this will be interesting, and I look forward to seeing what other commentators on this exposure draft will say to this one. Another aspect is sustainability focus generates new transactions and events. So we got pricing mechanisms, emission rights, carbon credits, how to account for those, or are there any commitments resulting from long-term strategy and policies and so on that you might consider a provision, you know, or something in this regard. So there's a lot of discussion in these papers I just mentioned here on these things as well. The implications for corporate reporting, though, the question here is, will we see fundamental changes in financial reporting? And there seems to be a couple of areas where it would be likely that we see some effect. And one obvious case is intangibles. So the key thing is that intangibles are almost not recognized as assets in financial statements. Okay, so they're just outside because they are too uncertain. Okay, that's kind of the idea. But here we are, looking much more forward into the future, and the question is, should there be information on intangible key intangible resources, and how does that work? Or would be internally generated intangibles, should they be recognized and as asset, for example? There could be some changes in the standards in the future. So really curious how this works out. For liabilities, the same thing. What about thresholds for provisions and disclosures about contingent liabilities? So we know of that, but would there be should there be more disclosure originally from such liabilities that are related to ESG things, but also pledges for emission reduction plans, for example. So I mean, there's some discussion in the ISB at the moment on these things to clarify, but I think the issue goes further along. Or prudence and disclosure of opportunities. So we have prudence to report about risks, but not about opportunities. But we could say opportunities is voluntarily reported, and in ESG, that will be a requirement also to report opportunities. And finally, integration of reports. There's long for many years there have been efforts already in the literature to come up with ideas how to integrate corporate or to have a full corporate report on things. And there's one example, the integrated reporting framework by the Value Reporting Foundation, and that's also now part of IFS Foundation. So it could be that this gets sort of additional life and interest, that in a couple of years we would come up with sort of one conglomerate total integrated report. We have seen many examples of ideas already in the literature, but none so far that's really sort of got people attached to it. But if the big standard setters, particularly IFRS Foundation, if they go along with those things, then probably we will see something arising along these sides. All right, that was what I thought I wanted to report, and I'm happy to take any questions if you have.
Thank you very much, dear Professor Alfred, for your excellent presentation. Thank you very much for your effort and contribution. Now, if anyone have any questions, you can open your mic and ask your question. Yes, if anyone have any questions, you can open your mic and ask your question.
Hello.
Yes.
Yes. Thank you, Dr. Alfred, about this presentation. I have just a question about the audit process related to sustainability reports. So I had a past as financial auditor myself. So my question is about the sustainability report audit process. Who could be well qualified to audit this kind of reports? So what is yes? What is the profile?
That's a very good question, an important question. Standard setters usually don't make requirements in this regard. Particularly, IFS Foundation does not talk about auditing. So this is like local law that requires auditing. And I can tell you for European Union, the CSRD has requirements for auditing of sustainability reporting. For the first couple of years with limited assurance, and later on, presumably with reasonable assurance, like what you have for financial auditing. So this starts in a slighter version with some auditing. So you can only give this negative statement, as you probably know. And then the question arises, who would do this? And in Europe, it's like a matter of the particular European member states. They can require only auditors, financial auditors, to do this, or they can open up for other, not auditors, but sort of other groups of people who must have sort of a relatively similar organization form with quality assessment and training and all these sorts of things. So there will be, as I understand, in many countries in Europe at least, that they would open up for other groups, like they have AMAS or auditors, for example, that would really have done voluntary disclosures or reports or sustainability reporting already. So there are groups of people, but this is like usually a hard to do thing, because it's also about business and also qualifications. So and as I said, I mean, in Europe it seems like that many countries would allow for alternative sort of auditors of sustainability reports. Others may not do this.
Thank you.
Wang?
Okay. Can you hear me clearly?
Yes.
Yes, thank you, Professor Alfred, about your presentation. I would like to ask about the, you mentioned about business strategy. Is it related with the prospector and defender business strategy or what? That's the first question. And then the second question, you haven't mentioned about the relationship with tax strategies, because I found in several literature that usually company do the CSR activities and then they report it in sustainability reporting, but they also perform tax avoidance. So what is your opinion about that? Thank you.
Mm-hmm. Thank you for the question. I mean, in terms of strategy, the standards, and I refer to IFRS and ESRS standards here mainly. They require that you have a strategy and you report on that. They don't tell you anything about what kind of strategy you do, be it sort of for the whole company, or being for parts of the company, and it would probably also depend on the issues. So if you do climate, if you look at climate, then your strategy regarding climate risk would be how can I move on to achieve particular objectives that what I showed, for example. Whereas if you have social issues, if you human rights kind of concerns or whatever, you need to think about rebalancing, changing your supply chain, for example, and things like that, or other measures. So it's not sort of the overall strategic management approach that you need to have. I mean, you probably should have that anyway as a large company, but these requirements in the standards go for particular areas of sustainability items, like climate related. So that's they don't tell you anything about what you really need to have there. In terms of your second question, I mean, you said kind of like tax avoidance and other effects of sustainability reporting. I mean, sustainability reporting might be the source for additional taxes, for example, if you have carbon tax and things like that. So that goes hand in hand. And here you would have tax avoidance ideally by emitting less, then you will pay less of this tax. Of course, that would be simple, but that's a direct instrument, so that wouldn't actually need reporting. In other terms, it goes back to my discussion, I think, on sort of having overall objectives and how to weight particular issues. In a sense, because tax avoidance is about you want to have more net profit, put it that way, simply. And with climate or other ESG measures, you may hurt sort of your profits already. So you might even try to increase tax avoidance measures, or do something in other terms. So it's hard to really combine those. I mean, they're related, but these are two different areas. In tax avoidance, you usually or very often say, this is my strategy in generally, and given what I'd like to achieve, it would be good to reduce tax, and you go in a particular country, invest there, or and things like that. But that might also have obviously sustainability issues at hand, particularly in the social area, I can imagine. So they're formally different, and there will be different departments in firms probably doing tax avoidance issues relative to sustainability crowd. Is that helpful?
Are there another questions? If anyone have any questions, you can open your mic and ask your question.
Hello, can you hear me?
Yeah.
Yes, Danielle. Yeah, you can ask.
Thank you, Professor Wagenhofer. I really enjoyed the presentation, but I also would like to extend my gratitude to you because you have been an amazing signpost in the past. You believed in my academic potential when I didn't do that myself, and so I'm still hanging in there in academia, and that's in part thanks to your support at the University of Graz when I was studying there. And my question, and I apologize if you've mentioned that, I had to step out for a couple of minutes when you were talking more about the differences between sustainability reporting and financial reporting. My question was, you've mentioned it will show in the future empirically if the reporting is indeed effective, and I understand that's more of in the value of the information. But I wonder, is there, from an analytical point of view or from your perspective, how does now the literature on planetary boundaries and like all these, there was this recent Lancet Planetary Health Commission report that talked about we need to look at it more from a macro perspective. How does that translate into our like entity perspective reporting, which isn't really covered by ISSP? And so if we're saying, oh, they push forward really strongly, and that's the direction that we're seeing that heading, is there an attempt to then say, well, it might be effective for something, but not for actually achieving planetary sustainability? So how bridging the gap of the organizational and the macro level kind of sustainability attempts, or I don't know if you have any thoughts on that.
Thanks for this question. This is the big question actually. So my understanding would be, and I started with telling there would be very different regulatory instruments to achieve more ESG goals, and disclosure is only one of them, and we still need to see how well it works relative to the others, because they all put in together, right? So we have carbon tax increases, and so you would expect that carbon emissions would be reduced because it gets more expensive in this regard. Whereas the disclosure is just there, and then people might react to that, or in particular industries or particular products. That might be the effect. But talking about sort of the micro perspective, my sense is obviously many of the ESG issues are really global issues. So it doesn't really help much if a country or even Europe or is a big player but achieves sort of certain objectives. So if the others don't, right? So and this is like there's in economics and game theory that there's some of these games where you have to coordinate with others, and so you always lose if you're the first mover and things like that. There are all sorts of aspects in this. So the EU at least believes, I guess, that they are big enough to do their own thing, and then they try to push other countries to some extent to think about it and to also come up with something. I don't think personally that ESRS will be adopted by many other countries outside Europe because it's very voluminous. But I think if they eventually we end up like with IFRS with sort of a common framework, and this could be the ISSB standards. saying this is like global, and EU requires a little bit more because they have this kind of double materiality issue in there, which the international standards don't have. So common baseline essentially, and then the mechanism at least would work worldwide, and that could improve the macro perspective essentially. You know, so but with all those things, I mean, carbon emission taxes and trading schemes, I mean, this is all, you have always these kind of problems if not all countries do the same thing. So I have no good solution, but you know, I mean, it has been tried hard, and maybe the momentum is here now, that people get more sense of what's going on and what to do. And I mean, consumers react to things. I mean, as I mentioned, that there's so many different areas where you see that people think about these ESG issues, and the more information, and this is the hope of the regulators, the more information you have on these things, the easier you could go on with macro items, but also on the micro side for a company that you try to be especially good in particular areas. So I think we need to see how fast the world moves in this regard, and it took quite a while for IFRS adoption in financial reporting, many years, but eventually we are close to. I mean, I was at the IFRS conference recently, and they had like 140 or whatever countries adopted IFRS, at least voluntarily or whatever. So eventually, I think it might take time, but that will be sort of the idea, I believe.
Question from Umair. Omar? Sah Omar, you can ask.
Hello, please, can you hear me? Thank you very much, Professor Alfred. Mine is just trying to have your thoughts about various the future of sustainability reporting in research, due to the fact that we have several standards. You know, we have the TCFD, we have the GRI, we have so many other things, and given that it's a voluntary case as at now in so many jurisdictions. So what is your thoughts about the future of sustainability reporting? Because I can see that there are so many biases and vested interests, you know, by countries, by organizations. So I don't know actually the position the sustainability reporting will be in the near future. Thank you very much.
Thank you for this question. I mean, we have quite a long history already with voluntary standards like GRI and others in particular areas, and we have a lot of expertise already, I guess, for many big companies voluntarily do this. So the key issue essentially, I think, will be then how much adoption of some of these standards would rise. And this goes back to my earlier sort of comment on the international things. I think that ideally we would like to have one global standard, I think, over not in the short term, but in the middle term, that would define what's most needed in terms of a global perspective. And this is what COP and other conferences and political leaders actually do all the time. So to get sort of a more of a perception that these externalities that companies produce essentially need to be accounted for. And so I think the problem here is, that the standards might be sort of differently set. I mean, you see it mostly for human resources, workforce, and things like that. So from a global perspective, you can't come up with the top ideal situation, because many countries would not be able to change that quickly or can't afford that for some time. So I would think like having sort of a minimum standard, and topping it up with others might be a feature where you can say, oh, we fulfill certain standards, but not all, but we already like good in a sense and try to do our best depending on the region in the world and their regulation. I mean, for many countries, well, the EU does a lot of things in this regard, and now particularly with those value chain oriented things, tries to essentially impose EU law to many other countries to some extent, right? To the companies if they want to make business with European companies. And I'm not sure whether this sort of really works, but this is like a little bit of an intention. And so I guess over time, so bringing those different standards together, and actually the IFRS Foundation tries to do this because, as I said, they already included a couple of sort of standards under their sort of umbrella, whereas GRI is at the moment different, but they work with EU and the in the AFRAC already, and they also work with IWSB. As well, so trying to get the best out of those things, but I guess in terms of a worldwide thing, you can't start with the top thing. You need to have sort of more like a bottom, and then gradually improvements and possible extensions and like modular standards maybe. So this is like a minimum standard, and this is like a add-on what you have, right? So to give countries and firms a chance to come up with sort of a common view of these global issues.
Thank you very much. Thank you.
Anan?
Yes, Dr. Muhammad, thank you for your effort, and thank you, Professor Alfred, for your presentation, excellent presentation. I have a question about how it's mandatory of sustainability reporting for the global organizations like the World Bank. It's mandatory or just still now voluntary?
As far as I know, World Bank does not require any of those standards at the moment. I think they are with financial reporting, they go like global, right? With IFRS. I don't know how far they are with sustainability reporting, but my suspicion would be they will start doing these things, but probably not sort of as detailed as these voluntary standards are at the moment, because this is probably too much for a couple of years at least before people get used to that and really get acquainted with what's required.
Thank you. Thank you for your presentation. And
are there another question? If anyone have any questions, you can open your mic and ask your question. If any questions, you can open your mic and ask your question. Jamil, you have a question? Thank you very much, dear Professor Alfred, for your contribution and your efforts. Thank you very much. Thank you very much, everyone joining us today. And thank you very much, dear Professor Alfred, for taking the time out to present it to us, dear Professor Alfred. Thank you very much. It's been really appreciated.
Thank you very much for attending. Thanks.
Yeah. And I hope to see you soon in Egypt. You are very, very welcome.
Thank you.